Okay, so this first one, I think deserves a little extra attention, depreciation. So let's talk about that. Depreciation is for property, plant, and equipment. That's what this PP&E stands for. Okay. Um, you're paying for these assets, machinery, furniture, vehicles. You're paying for it up front, and then you're going to expense it as time goes on because those things lose value. Do we agree that as you use machinery, as you use vans, as you use furniture, do we agree that those decline in value? Yes. Okay. You're using them up in the case of like a machine, right? It's gonna the more you use it, the closer it is to becoming garbage. Okay. So we can't hold those assets on our balance sheet at what we paid for it because they're actually getting used up. So the way that we account for them for this usage of time, the usage of the asset, time going by, is through this thing that we call depreciation expense. Okay. So again, we're trying to match the PP&E asset, the cost of it with the period of time that it benefits. Okay. Um, it's not cash. Okay. So this is a key thing. Depreciation expense does not involve cash because we've already bought the item. Okay. Now we're just expensing it as time goes on. Okay. So it's not going to involve cash. It's going to involve a debit to an expense, just like all expenses are debit normal. We're going to call it depreciation expense. And we could, okay, so hypothetically, let's say we had our van that we purchased for 50K. And let's say every year our depreciation expense for it is $2,000. Okay. What we could do is, okay, we could have the depreciation expense 2,000 and just reduce this asset by 2,000. So now it's worth 48. Now this is conceptually correct. Okay, we're kind of depleting the value of the asset over time, right? That's the point of doing this. But we, for our accounting system, want to preserve how much we paid for that van. We want the historical cost basis preserved because if we just directly credited van 2000, the new balance for van is going to reflect this depreciated amount. We're going to have lost how much we originally paid for it. Okay. So what we're going to do is have a buddy account. It's called a contra account called accumulated depreciation. And it's going to be linked to van. These two are going to go together. They're buddies. Okay. Van is going to be a debit normal account, as all assets are. Accumulated depreciation, since it's a contra account, we know the word contra means against. It's going to be a credit normal account. Okay. So we'll keep this depreciation expense the same, but we'll now credit this accumulated depreciation account. This is going to be 2,000. So now on our balance sheet, you'll actually see the company report the historical cost of the assets and separately report all the accumulated depreciation. So you can see, it will tell you how old the stuff is. You know, if you saw that the historical cost of the van is 50,000 and the accumulated depreciation is 2,000, right? You can tell that they're pretty new, right? The accumulated depreciation is not that much, right? So it is useful. There's some information in separating them. Okay, so I'll show you how this is done in a second. Um, okay, so what else do we got to say about this? So yes, accumulated depreciation. We want to again uh, preserve the historical cost of our assets. Um, the book value of our assets. This is kind of a terminology that's used. Is the original price minus the accumulated depreciation. So in the case of our van, what is the book value? 48,000, right? It's 50,000, which is the cost minus our accumulated depreciation, with this 2. And the next year, we're going to do another 2. And the next year, we'll do another 2. So now what is my balance? It's 6,000 here. What is the book value after 3 years? 44,000. Exactly. Okay, good. Okay, so um, also a key thing to remember, maintenance expenses, like for my van, doing the oil change, you know, washing it, changing the brakes, all those maintenance items are a different expense. Depreciation expense is just accounting for the cost of buying that asset. Okay, so keep that in mind. Maintenance expense and depreciation expense are 2 different things. I'll say it again. Maintenance expense and depreciation expense are 2 different concepts, right? Depreciation expense is only for accounting for the purchase of that asset. The cost of maintaining it is separate. Okay, I'll skip that. Okay, so what do you need to calculate depreciation? There's 4 things. How much you paid for it, how long your business intends to use it. It's not necessarily the physical life of the thing, okay? There's the service life versus the physical life. I could drive a van for 30 years. Why does FedEx not have any vans that are 30 years old that it's using in its fleet actively? They're outdated. What else? What if they break down? Is that going to mess up their delivery schedule? Yeah, so they need them to be reliable. Yeah, they're probably smaller, they're less energy efficient, right? So FedEx maybe has a 5-year life on their vans, even though at the end of 5 years, they still have value, right? So we care about this useful life, okay? Not the actual physical life. So we have how many years or how long the company intends to use it. At the end of the life, like those FedEx vans, they have some residual value, right? The company can sell them and get something for it. So we need to know what that is. And then we need to know the depreciation method. Okay, so plotting this on our graph here, at t equals 0, you're going to have, let's say our van is 50K. Let's say we intend to use it for 5 years. 5 years. Let's say at the end of 5 years, we think it's going to be worth 20K. So it's going to be here. So we're starting here. We're going here. How many ways can we connect these 2 points together? It could be a straight line. Any other methods or any other ways we can connect this? Yeah, there's infinite actually. Okay, it could be we could take a lot of depreciation in the first years and then very little. We could take all the depreciation in the first year, I guess like this, and then there's none in the others. So there's actually an infinite amount of ways to connect these 2 points, which is why we need this 4th one, which is our method, okay, depreciation method. That tells us every year how much depreciation expense to take. The straight line is very easy because it's assuming basically the same change every year. This, 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 this. All these are equal. To go from here to here is this amount, which is the same as this, which is the same as this, which is the same as this, which is the same as this. So every 5 years, you take the same amount of expense. Okay? There are some accelerated depreciation methods where you take much more expense in the first year and then less in the later years. Okay, we're going to learn about that in chapter 9. But for now, we're just going to use a straight line, okay? Because it's the easiest. So in this case, how much is it per year? If we're going to from 50,000 to 20,000 over 5 years, what is the yearly depreciation? Yeah. See, how'd you get that? Exactly. 50K minus 20K divided by 5. That's equal to 6,000 per year. Exactly. Okay. So the straight line method is quite easy. You just take your starting point minus your ending point divided by the number of years. Okay, so if it was starting at 50K, let's say we're going to use it for 7 years instead. And in that case, it's going to go to 10K divided by 7. Okay, so it's the same formula. You just have to plug in what your assumptions are. And from that, you can get a schedule like this. This is a depreciation schedule. Okay, so in this case, our acquisition cost was 10. We're assuming a 5-year useful life, residual value of 2,500. We get a depreciation expense of 1,500 per year. You can see it's the same every year. You can see the book value every year. So after the first year, it's 8,500, 7,000. So it's reducing by 1,500 every year. And you can see at the end of 5 years, we get to our residual value, right? So we started at 10, our residual value is this. And every year, we're just taking the same step down. And the way I know I did this right is that at the end of 5 years, I'm at my residual value. Let's look at a real example of this. So this is Rivian, okay? Uh, this is a summary of their assets, their property, plant, and equipment assets. You can see here that all this, they've divided all their property, plant, and equipment into different buckets. They have land, buildings, building improvements, 972 million. Machinery, equipment, vehicles, office furniture is 3 billion. I think this is the right units. And so if you add all this up, their total property, plant, and equipment is like 5.7 billion. Okay. Right underneath it, they have accumulated depreciation and amortization. So this 5.7 is how much they originally paid for all this stuff. Okay. Underneath it is all the accumulated expenses for depreciation they've taken since they've owned these assets. And it's all going to be different time periods, right? Some of the assets are older, some of the assets are newer. To know the full details, we'd have to see their accounting books, but they've just given it to us in aggregate. Okay, so you can see that it's 1.7, and you can see some of the estimates. So their land building and improvements, the estimated lives, again, they have many buildings, many, so they're just giving you a range of what they are, because some of them are going to be 10 years, some of them are going to be 20. And again, to see that detail, we'd have to have access to all their accounting books, but it's between 20 and 30 years. The machinery, equipment, vehicles, it's between 2 and 10 years. Some of the machinery maybe goes obsolete or wears out really fast, so they only have a 2-year life. Maybe some of the vehicles that they own, they have a 7-year life. Okay, so it's all going to vary depending on what type of asset it is. Yeah. Yeah, so land is not depreciated, but just to include it, how much total real estate you can say they have, they've included the land. Well, yeah, because yeah, you're right. Land should be 0 to 30 years. Technically, you're right. Or actually, no, 30. I mean, they're not going to depreciate the land. I don't know. Yeah, that's a good question though, because it's not 0 to 30. It'd be 10 years to infinity. Because like the land is infinite useful life. But yeah, they're probably just assume that the land. They'll know that the user is like, yeah, they know the land is not depreciated. Okay. Okay. Any questions on this? I just wanted to show you that this is actually how it's presented. Okay. We're not just learning something that's theoretical. Okay. And if you were an accountant at Rivian, you would have all the schedules for all the assets that you own. There would be a schedule for all the different assets, the amount of depreciation expense for each one, and then the financial statements in aggregate will just add up everything, and that will be your depreciation expense for the year. Okay, but again, it's gonna be a lot of detail. They probably own thousands of assets. Okay, so the details of this is gonna probably be someone's job at Rivian just to manage this.